Hey everyone, welcome back. Ready to dive into another deep dive with us? Today we're tackling something that's essential for any investor, no matter where you are on your journey: asset allocation.
Ah, asset allocation, the art and science of spreading your investments, right? It's like deciding how much you want in stocks, bonds, real estate, maybe even a little spice with things like hedge funds or commodities.
Exactly. And, I think a lot of people feel like it's this big, confusing mystery. But we're here to break it down, make it a little less intimidating.
Yeah, definitely. And we've got some great resources to help us do just that, including excerpts from The New Science of Asset Allocation. It's a bit of a dense read, though, so we'll do the heavy lifting for you.
We'll pull out the key insights, the stuff that really matters for making smarter investment decisions. And, sometimes even the experts can get a little lost in the weeds.
Oh, totally. Like, I'm in this world every day, and sometimes I need a reminder to step back and look at the big picture.
Exactly. That's what this deep dive's all about. So let's start with the basics. What is asset allocation? Why does it matter so much?
Well, at its core, it's about balancing risk and potential return. You're not putting all your eggs in one basket. Like, what if all your money's in stocks and the market takes a nosedive?
Oof. Yeah, nobody wants that. Diversification is key, right?
Absolutely. And it's not just about spreading things out randomly. It's about being strategic, understanding the role each asset class plays in your portfolio, how they interact with each other.
Okay, I'm following you. So it's not just about making money, it's about protecting what you've earned, too.
Exactly. It's about not losing it, which is, sometimes more important. And this quote from The New Science of Asset Allocation really gets to the heart of it. Since expected return is based on expected risk, the real focus in asset allocation should be on defining, measuring, and managing expected risk.
So risk is at the center of it all. But, that word risk, it can be kind of vague. What are we really talking about when we say risk in the context of asset allocation?
It's a great question, and I think one of the biggest mistakes people make is focusing on just one dimension of risk. Like they obsess over standard deviations.
Standard deviation, right? That's how much an investment's returns bounce around up and down over time.
You got it. But it's only part of the story, and the book highlights this really well. It says that often we measure what we can, not necessarily what we should.
Okay, so like we're shining the flashlight on the easy stuff,
Yeah.
even if it's not the most important.
Exactly. Like imagine you're trying to find your lost keys on a dark street. You're going to naturally focus on the areas lit by the streetlights, right?
Yeah, even though your keys could be in the shadows somewhere.
Precisely. So we need to broaden our view of risk. Look beyond just standard deviation.
Okay, so beyond standard deviation, what other aspects of risk should we be considering? What else is lurking in those shadows?
Well, for starters, we have the Sharpe ratio, which tries to measure risk-adjusted returns. How much return are you getting for the level of risk you're taking?
So it's not just about chasing the highest returns. It's about finding that sweet spot where you're getting compensated appropriately for the risk you're taking on.
Exactly. But even the Sharpe ratio has its limitations. The book warns against using it blindly, especially during periods of overall market decline.
Okay, so it's a useful tool, but not a perfect one.
Mm.
What else should we be paying attention to?
Then there's skewness and kurtosis, which look at the shape of the return distribution. Like, is it a nice symmetrical bell curve, or does it have those fat tails, meaning extreme events, both good and bad, happen more often than you'd expect?
Fat tails. That sounds kind of scary.
It can be, especially if those tails are on the negative side, meaning there's a higher chance of big losses. But, positive skewness with the fatter tail on the right side, that's what a lot of investors dream of.
Yeah, who wouldn't want a higher chance of those outsized gains?
Right. But it's often hard to achieve, especially in diversified portfolios. Spreading your investments across different asset classes can actually smooth out those extreme outcomes, both positive and negative.
Oh, so diversification, while it's great for managing risk, might also limit those chances of hitting it big.
Exactly. It's all about trade-offs, finding that balance that works best for you. And I think that's a good segue into our next topic, the evolution of asset allocation models.
Okay, so we've gone beyond just that simple stocks and bonds approach, right?
Yes. We've entered this exciting new world of multi-asset portfolios, including things like real estate, private equity, hedge funds, even managed futures.
It's like venturing beyond the familiar, exploring those uncharted territories in the investment landscape.
Exactly. But it's also made things more complicated. As global economies have become more integrated, correlations between those traditional asset classes have increased.
So diversification isn't as simple as it used to be.
You got it. That's why understanding the unique characteristics of each asset class, including those alternatives, is more important than ever.
Okay, so let's talk about those alternative investments. I think a lot of people are curious about them, but also a little intimidated. What's the real deal with things like hedge funds? They seem so mysterious.
Well, they can be a bit opaque, that's for sure. But essentially, they're investment pools that have more flexibility than your typical mutual fund. They can use leverage, borrowed money to potentially amplify returns.
Leverage, that sounds risky. Is that why they're often associated with those high net worth individuals, those big institutions?
That's part of it. Hedge funds often have higher minimum investments, and they're generally less regulated than traditional investments. And yeah, they can be risky, but that risk is kind of the point. It can be a tool, not necessarily a bad thing.
Okay, so it's all about understanding those risks, knowing what you're getting into,
Yeah.
and not all hedge funds are created equal.
Absolutely. They come in all sorts of flavors, from equity long short to global macro, each with its own risk return profile. Some might zig when the market zags, while others might amplify those market moves.
So it's not about labeling them good or bad, but about understanding how they fit or don't fit into your overall strategy.
Exactly. And I think that's a key takeaway from our deep dive so far. We need to go beyond those surface level labels, really dig into the nuances.
Nuances, that's the word of the day. So besides hedge funds, what other alternative investments are out there?
Well, we've got managed futures, which are run by those professional traders, the CTAs. They invest in futures and options across various asset classes, trying to ride those market trends. Then there's private equity.
Private equity, that's always sounded so exclusive, like something only the ultra-wealthy have access to.
It used to be, but it's becoming more accessible these days. It's about investing in companies that aren't publicly traded on those stock exchanges.
So instead of buying shares, you're investing directly in the company itself.
Yes. And that can come with some potential advantages, like private equity firms are often actively involved in the companies they invest in, working with management to try to improve things, drive growth.
So it's more hands-on than just passively holding a stock.
Exactly. But it also comes with its own set of risks and considerations, like it's typically less liquid than public markets. You're committing your capital for a longer period.
Okay, so patience is key with private equity. And then, of course, we have real estate. I mean, everyone's familiar with that, right? At least on some level.
For sure. Whether it's owning your home or thinking about rental properties, real estate is something most people can relate to. And it can be a valuable part of a diversified portfolio.
Yeah, it feels tangible. You can see it, touch it. It's not just numbers on a screen. But is it really that different from stocks and bonds in terms of how it behaves in a portfolio?
Well, it has its own quirks, that's for sure. Like real estate is often seen as good inflation hedge. When prices are rising, real estate values tend to keep pace, which can help protect your purchasing power.
So it's like a built-in shield against those rising costs we're always hearing about.
Exactly. But like anything, it has its downsides too. It can be illiquid, meaning it takes time to sell a property if you need to access your money quickly.
Okay, so it's not a quick fix. And what about those commodities? Oil, gold, wheat. It feels like we're really venturing into the wild west of investing now.
Haha, in a way you are. Commodities are raw materials, the stuff that drives the global economy. Their prices are driven by supply and demand, which can be influenced by all sorts of things, from weather to geopolitics, you name it.
So a lot more unpredictable than those traditional assets.
They can be. But that volatility can also present some unique opportunities, especially if you're looking to diversify your portfolio and potentially cushion it against losses during market turmoil. Because those commodity price movements often don't follow the same patterns as stocks and bonds.
Okay, so they can act as a bit of a shock absorber.
Exactly. But remember, they can also be risky. You need to do your homework, understand the factors that drive those commodity prices.
Do your homework. That's a recurring theme here. So, with all these different asset classes, traditional and alternative, how do we even begin to decide which ones to include in our portfolio?
Well, that's where the rubber meets the road, right? It's all about figuring out what mix of investments is right for you. And there are different models and frameworks we can use to help us make those decisions.
Okay, so it's not just about randomly throwing darts at a board. There's actually some science behind this.
There is. And one concept that I think is really helpful is the idea of benchmark indices. Like the S&P 500 for stocks.
Right, the benchmarks. So we can compare how our investments are doing relative to how the market as a whole is performing.
Exactly. But it's important to remember that benchmarks are just representations. They don't capture the full universe of investments within a particular asset class, and individual investments within a class can behave differently.
Okay, so it's not a perfect comparison, but it gives us a general yardstick to measure against.
Right. And the choice of benchmark can really influence how we perceive the performance and risk of an asset class.
So different benchmarks could paint very different pictures.
They can. The book gives a great example using private equity. There's a big difference between benchmarks based on public securities versus those based on accounting data. Those different benchmarks can lead to very different interpretations of historical performance. Like, one might show great returns, while another might show more modest results.
Wow, that's really interesting. So benchmarks can be helpful, but we need to be aware of their limitations, understand what they're actually measuring.
Exactly. And then, of course, there's the concept of alpha, that elusive measure of manager skill or strategy that generates returns above the benchmark.
Alpha, the holy grail of investing. But does it really exist? Can anyone consistently beat the market?
That's the million-dollar question. And the book doesn't shy away from that debate. It acknowledges the difficulty in accurately measuring alpha, especially in those illiquid markets like hedge funds and private equity.
So it's hard to tell if those outsized returns are truly due to skill or just luck or some other factor we haven't accounted for.
Exactly. But even if alpha is difficult to measure, that doesn't mean it doesn't exist. There are definitely skilled managers out there who can add value, especially in those less efficient markets where information isn't as widely available.
Okay, so it's not a black and white answer. There's nuance here too. But I think we've covered a lot of ground in this first part of our deep dive. We've talked about the different asset classes, the various dimensions of risk, the evolution of asset allocation models, even touched upon benchmarks and alpha.
We have. It's been a great overview, laying the foundation for the rest of our discussion.
Exactly. And in the next part, we'll dig deeper into those specific asset allocation models and strategies. How do we actually put all this knowledge into practice?
I'm looking forward to it. We'll explore those different approaches from the traditional to the more cutting edge and see how they can help us build portfolios that align with our individual goals and risk tolerances.
Awesome. So stay tuned for part 2 of our deep dive into asset allocation. Okay, so we've laid the groundwork. We've got a better sense of those different asset classes, how we think about risk. Now let's dive into the nitty-gritty of actually building a portfolio.
Let's do it. I think one of the biggest challenges for investors is deciding how to allocate their assets, like what percentage goes to stocks, what about bonds, real estate.
Right? It can feel overwhelming, all those choices. So where do we even begin? Are there any rules of thumb, frameworks, models, something to help us make sense of it all?
There are, and those models have evolved quite a bit over time, actually. Traditionally, asset allocation was pretty much focused on stocks and bonds.
Okay, the classic stock-bond split. I've heard about that, but I'm guessing it's not that simple anymore, right?
Not quite. You might have heard of that old rule of thumb, subtracting your age from 100 to determine how much to put in stocks.
Oh, yeah. Like if I'm 30 years old, I'd put 70% in stocks and 30% in
Wow.
bonds. Is that still a good idea?
Well, it's a starting point, but those traditional models have some limitations. They don't always account for things like, well, inflation, for example,
Mhm.
or taxes. And they definitely don't factor in those alternative investments we were talking about earlier.
So we need something a bit more sophisticated, especially in today's world, with all those new investment options and all the crazy stuff happening in the markets.
Exactly. And that's where those newer models come in. They often incorporate a wider range of asset classes, including alternatives, and they consider multiple factors, not just your age or how much risk you're comfortable with.
So it's not one size fits all, more like a custom-tailored suit.
I love that analogy. And these newer models often use some fancy statistical techniques to assess different scenarios, like Monte Carlo simulations, for example.
Monte Carlo simulations. Sounds intriguing. What are those all about?
Imagine running thousands of virtual trials, each with slightly different marker conditions. You get a better picture of those potential outcomes for your portfolio, not just a single best case or worst case scenario.
Okay, so it's like peeking into a bunch of parallel universes, seeing how your investments might play out under different circumstances. That's pretty cool.
It can be, but remember, any model, no matter how fancy, is only as good as its inputs, right? You need to understand the assumptions behind it, work with someone who knows what they're doing.
Right. Don't blindly trust the robots. Human judgment is still important.
Yeah.
But okay, so we've got these more advanced models, but it still feels a bit daunting, to be honest. Where do we start? How do we actually pick those specific investments for our portfolio?
Well, that's where things get really interesting, right? And one approach that I find helpful is what's called core and satellite investing.
Core in satellite. I had heard of that one. Break it down for me.
Okay, so the core of your portfolio, that's your foundation, your bedrock. It might consist of those core asset classes we've been talking about, like stocks, bonds, maybe some broad real estate exposure.
Okay, so the core is like that solid base, those bread and butter investments that help us diversify and manage risk. What about the satellite part?
Ugh, that's where things get a bit more, well, let's say spicy. This is where you can be a little more targeted, express your own views, maybe tilt towards areas where you see opportunity.
So like if I'm really bullish on emerging markets, or I think clean energy is going to be the next big thing, I could allocate a portion of my portfolio to those areas.
Exactly. The satellite portion is where you can play with those specific themes or sectors, maybe invest in those niche strategies. Maybe a hedge fund specializing in biotech or a private equity fund focused on infrastructure.
Okay, so the core is about diversification, managing those broad market risks, and the satellite is about expressing those individual views, maybe boosting returns with those targeted bets.
You got it. But remember, those satellite investments should complement your core, not replace it. It's all about balance and diversification. You don't want to get too carried away with those niche plays.
Right? Don't let the tail wag the dog. So it's about having that solid foundation with your core and then carefully adding those satellites to fine-tune the portfolio and potentially enhance returns. I like it. But okay, let's be honest. There are so many options out there. How do we even begin to choose those specific satellite investments?
Well, it's about doing your research, understanding the risks and potential rewards of each investment, and maybe seeking some professional guidance if you need it. Talk to a financial advisor who can help you navigate those choices and make sure those investments align with your goals.
Right. No substitute for good old-fashioned due diligence. So we've covered a lot of ground here. We've talked about different asset classes, risk management techniques, portfolio construction frameworks. But before we wrap up this part of our deep dive, I have a question that's been nagging at me.
Okay, shoot. I'm curious to hear what's on your mind.
With all this focus on asset allocation, with these models and strategies, does manager skill even matter anymore? I mean, if we're just following a formula, are we basically saying that it doesn't matter who's actually managing our money?
That's a great question, and one that's been debated for, well, probably as long as investing has existed. On one hand, as we've seen, asset allocation plays a huge role in determining those overall portfolio returns. Getting that mix right is crucial.
So even if you have the best stock picker in the world, if they're invested in the wrong things at the wrong time, it won't matter much.
Exactly. But, that doesn't mean manager skill is irrelevant. Within each asset class, there are still opportunities for skilled managers to generate alpha, those returns above and beyond what the market delivers.
Okay, so it's not an either situation. Both asset allocation and manager skill have their roles to play.
Absolutely. And how much each factor matters can vary depending on the specific asset class. In those highly efficient markets like large cap US stocks, it can be really tough for managers to consistently beat the index.
So in those cases, maybe sticking with the low-cost index fund and focusing on getting that asset allocation right makes the most sense.
That can be a very effective strategy, but in those less efficient markets, like emerging markets or maybe small cap stocks, there might be more opportunities for skilled managers to find those hidden gems, those undervalued companies.
Okay, so it's not one size fits all. We need to consider the specific characteristics of each market and the track records of those managers operating in those spaces.
You got it. And it's always important to remember that past performance, no matter how impressive it looks, doesn't guarantee future results.
Right, no crystal balls in investing. We can't just chase those hot returns without understanding what drove them and whether those factors are likely to persist. It's all about being informed, doing our homework, making those smart decisions that align with our goals.
Couldn't have said it better myself. And I think this leads us perfectly into the final part of our deep dive, where we'll explore those common pitfalls, those mistakes investors often make, and how to avoid them.
Sounds like a plan. Because, let's face it, even with the best intentions, we can all get tripped up sometimes. So let's learn from those mistakes, make sure we're on the right track.
I'm looking forward to it. So, ready to wrap up our deep dive into the fascinating world of asset allocation.
I am. And it's funny, we started this whole conversation talking about asset allocation as this puzzle we're trying to solve.
Right, fitting all those pieces together. But now it feels like the puzzle itself is changing, evolving.
It is. I mean, we've talked about the rise of those alternative investments, how those lines between asset classes are blurring, all that increasing complexity. So with all that in mind, what does the future of asset allocation actually look like to you? What's your take?
Well, I'm no fortune teller, but I do see some key trends gaining momentum. For one, I think we'll see even greater personalization in asset allocation. It's going to move beyond those generic models, the ones based just on age or risk tolerance.
Towards something much more tailored, customized to the individual.
Exactly, like a truly bespoke investment plan that takes into account everything from your financial goals to, well, your values, even those unique quirks in your risk appetite. And this personalization, it'll be powered by technology, of course.
Yeah. We're already seeing those robo-advisors and AI-driven platforms popping up everywhere.
And they're only going to get more sophisticated. So imagine a world where you have this virtual financial advisor available 24/7, constantly crunching data, tweaking your portfolio, even learning from your behavior to give you better recommendations.
That's kind of mind-blowing. But even with all this amazing technology, I still think that human element is important, right? Especially for those really big, complex decisions.
I agree. It's not about replacing human advisors completely, but giving them better tools, augmenting their capabilities so they can help their clients even more effectively.
Okay, that makes sense. So tech and human expertise working together. What else do you see on the horizon?
Well, I think the search for uncorrelated returns, that's going to continue to be a big driver. Finding those elusive investments that zig when everything else sags.
Right, because that's the holy grail of diversification.
Yeah.
Right. Finding assets that don't all move in the same direction at the same time.
Exactly. But with so many options out there, finding those hidden gems is going to be a challenge. And I think we're going to need better tools to help us. More sophisticated analytical platforms that can really sift through that data and identify those potential sources of uncorrelated returns.
So the future of asset allocation is more about like constantly adapting, being open to new possibilities.
I think so. Embracing that uncertainty, being willing to challenge those old assumptions. Because let's face it, the investment landscape, it's constantly in flux. There's no magic bullet, no set it and forget it solution.
Yeah, it's a journey, not a destination. And honestly, it can feel a bit overwhelming at times.
Yeah.
All this complexity, the rapid pace of change.
I hear you. It can definitely feel daunting. But, knowledge is power. The more we understand about these trends, the better equipped we'll be to navigate those challenges and grab those opportunities when they arise.
But stay informed, stay curious, never stop learning.
Exactly. And remember, even in this increasingly complex world, some fundamental principles still hold true.
Like what? Give us some parting wisdom to ponder.
Well, diversification, risk management, maintaining that long-term perspective, those are the cornerstones of sound investing. They'll always guide us, no matter what the future throws our way.
That's a great reminder. Well, this has been an incredible deep dive. Thanks so much for joining us and sharing your expertise.
My pleasure. It's been a great conversation.
And to all our listeners, thanks for tuning in. Remember, the journey of learning never ends. So stay curious, stay engaged, and keep seeking knowledge. And until next time, happy investing.